Okay, guys, welcome to today's video. Wonderful. We are at day 60. It's not an easy journey so far, but we have been pushing it 60 days so far, and I'm so excited. Right? Okay, so yesterday we talked about structural confirmations in order for us to determine that bias on higher time frames before we go to lower time frames to look for entries. So today I said I'll be discussing more on structural confirmations that you can use on what lower time frames, right? To in order for you to confirm your entries and you can go ahead and take that trade. It's a very um, good concept, right? The only thing that affects this particular concept is if you do not have patience, right? If you're not a kind of a patient trader, you just want to go in really fast. You don't want to wait for structural confirmations, but it will save you time. It will save you a lot of panic because you know that you have not waited for confirmation. You just went ahead and take that trade. So there may be high chance that the chances of you losing that trade is more higher than right someone that waited for confirmation and it will just his bias is clear. He has seen the structure shift and that person will just enter that trade stress free. Okay, so I'll be giving you several examples on chat. I think there is okay, good. We can see one on BTC, right? One of the trade I caught. Now, if you look at this clearly, let's go to our analysis time frame, which is 4 hours time frame, right? You look at the way the market has been moving, right? If you follow the story, all the story of the market from this region, you understand. I think I'll talk about understanding the story that the market has been right printing. Follow that story all the way here. What the major structure you can see, right? From all this place, it's looking like noise. If you want to identify, you have a low, a high, a low, right? Market created break of structure here, giving you a new low, a high, a low, a high, a low, a high, right? So the current swing low, swing high is this, right? You have a low here, you have a high here, and you can see this clearly on the 4 hours time frame. Just follow me, right? Let's understand what price has been printing. Okay, you can see this 4 hours time frame. There's a clear break of structure here. So on this region, it means this is a swing low, and this is the swing high, right? Then all of a sudden, market is retracing into lower regions. And remember, we know how price move, right? Internal to external, right? Internal liquidity to external range liquidity. Remember when we talked about structure, right? For market to move from a low to a high, market needs to what? Come into a level of internal range liquidity so that it can go and sweep out external range, right? Comes into a level of internal range, go out and sweeps the previous high, which is the external range. That's how liquidity fuels the market in an uptrend, right? So now the first move you saw here is there was a high, a low, a high, right? So market has broken structure. Okay, so structure shift, right? So as the trader, you would want to work on this low and this high. Those are your target. So if you see market retracing into regions, right? You would first of all, right? The first thing you want to do here on this structure, after identifying that there's been a break of structure, you have a swing low, a swing high. Okay, what you want to look for first is to calculate the discount, and for that you saw market already making moves to retrace, right? You saw market making moves to retrace, so you mark the swing high, use your Fibonacci, mark the swing high to swing low, right? Then you take out the 50% region, right? You identify the 50% region. Once you've done that, it means as long as market's on this region, right, you have no business catching buys above this region, right? But you have business catching sales. You can catch sales above this region to lower regions, right? But as long as price is here, you have no business catching buys for continuation, right? But if as long but immediately the market started moving into the buy zones, it means at any of this region, if there's a valid POI for you to take your buys, you can actually go ahead and take the buy for a continuation, right? So that's just the simple rule you need to use. Above the 50% region, if you're looking for premium zone, this is discount. So if market is dancing around this region doing moves like this, you don't even want to catch any buys here, because any buys might just be that trap, right? Market might just create a trap around this region. So since this is premium zone, you want to look for sales. But as long as any sell you take from this premium towards the downside, once it gets to a buy region, you should be careful. Look for any valid POIs till market disrespect that POI before you can now say, oh, the structure doesn't want to go bullish, right? But as long as you've taken profit, taking sales from this place, if you're going into the demand zone and you know the structure is bullish because the current structure that changed is bullish, right? So it means if I'm selling against the trend. I just want to sell into discount region, then I'll close my trade so that if I catch a buy, I would now continue, right? But if I don't want to take that risk, I just wait, right? I can be patient to wait for market to retrace into discount region. Then I will now wait for another structural shift. If I see another structural shift, then I can now take my buys, right, to the upside. Okay, so that's how you can just have that setting. You need to have that rule construct based on structure and based on liquidity to see. Now we've talked about liquidity, now we're talking about structures, the changes you need to see market react, right, before you have a confidence to take your trade. Now we have seen this market did that shift, and if you look at this structure, all the buys, these are for us our analysis time frame, right? We had a buy from here, buy from here, buy from here, buy from here. Now if we were to mark all the imbalance of the buys, right, all this way. Now before that, let's do the first thing. After we have identified the structure, right, low, high, the next thing we want to do is to mark out swing highs, use our Fibonacci so that we can get the 50% region, right? So now let's get 50% region. Let's draw an horizontal line there. Okay, good. We have gotten our 50%. Remember, market just created a break of structure, so you are interested in this range. Now you saw market moving down, right, after the shift in structure. You are doing this on your analysis time frame. Now you saw market selling, right? It means market maybe wants to retrace. You do not know, right? But now you have marked a 50% region. It means anything above this region, anything right above this region, you do not really care to catch sales. You don't want to dare to catch buys as long as you're above this line. Can I draw the highs so that we'll see it clearly? Let me take this out. So let me make 3 horizontal lines here so that we'll understand that this is the swing high and this is the swing low, right? So the middle line, the midpoint line, let me delete this. So I'm taking this really slow, so I want you to understand. It works on all pair, but most times it's not easy to follow because you might not have that time to be patient to want to see how the story is playing. Okay, so we have a swing low, we have a swing high. These two lines. Can I even color them so that we can differentiate it? I think we can give it a color. So let's say red. Yeah, let's say red for the swing high. Let's say yellow for the swing low. Then the black is the 50% region. Okay, so anything within the black and this guy, we do not want to even catch buys, right, based on this low to high. Anything here as the market is facing, that's where we want to look for buys. That's one. We have identified the first rule. We have marked discount and premium regions. Now the next thing is to look at this structure. If market is moving from a high after taking liquidity here and it's retracing, we know that market might be moving into a region of an imbalance, maybe where market wants to catch buys continuation from, right? So if we look at all this imbalance at this region, right, you see that there is a slight imbalance here, and this imbalance is resting in the discount region, right? If you mark that, a little imbalance here resting on the discount region, and we also have an imbalance here, but this one is resting at the premium region. I want to catch buys, so we don't really care about this one, right? We'll be interested in this tiny imbalance that price created here for a buys and this buy order block that is resting here. Okay, so now we have identified this, and all we just need to do is to wait for price action. Let's see how price reacted. So if you go to lower time frames now, the 1 hour time frame, say 1 hour time frame, right? Now this is that break of structure we saw. Right, this is that break of structure we saw. This the swing high, this is the swing low we've marked. Okay, now this market pulling in to that first imbalance we saw on the 4 hours time frame, right? Pulling into that first imbalance we saw on the 4 hour time frame, market tapped into it, moved up, right? Coming back down, market still reacted off the order block. Now this will give you a good valid trade, but not maybe a full confirmation. If we have, say this was the imbalance, market tapped into on 4 hours time frame, but if you look at this structure here, you see that this order block, market shifting to this order block, right? The first order block is here. I know lots of people marking this order block, but this order block, market tapped into it. So this one is now the valid order block we can use, just close towards that POI. So this region right here. Okay, now market tapped into this, moved up, came back down. So this is like an SMC setup for engineered liquidity. Right, this like an SMC setup for engineered liquidity. Now you marked a POI, right? You marked a particular POI and you wait. Now this is where I want to really talk about. This is where structural confirmation comes in. Now you've marked this POI. Now aggressive traders can actually take trade off this POI. Of course, is valid. There is a slight imbalance, right? Market filled into interval and pushed up, came back down. So this acted as an inducement, right? When it got into this sell zone, it pushed price down, right? Market came, swept this inducement, tapped into the POI, and what happened? Market shifted structure here. On this time frame, you can see the previous low that brought market down, right? The previous low that brought market down, market what? Shifted the structure here. Now market made a shift in structure here. So structural shift. So if you are not taking a trade aggressively under this, why is this a structural shift? If you look at the 4 hours time frame, you notice how price moved. Price made a low, a high, a low, and closed below, right? And closed below. Price actually closed what? Below this region. So this low did a break of structure. So when market moved and took out this low, it created a structural shift, right? Confirming that this guy wants to go higher. If not, market would not have invalidated this particular order flow here. This last green candle, market would not have invalidated this last candle here, but you saw market invalidating the order flow, going higher. So immediately you saw this, it means market shifted, which you can see that confirmation on 4 hours. You can see it very clearly here. So this gave me a shift, right? It means market wants to actually go higher, confirming that, oh cool, I can take trades off this particular POI. And market created a structural engineered liquidity right here, a tiny one, and a beautiful buy at this region. Now this was the first POI, but this is the confirmation entry to target higher regions where market can what? Buy into. Okay, so this is part of structures, that confirmation structural entries you can need to see on smaller time frame to confirm your. So if you are not taking trade off this region, now you saw the structural shift. This is the confirmation entry, this is the aggressive entry, this is the confirmation entry, and you can see how market went ahead to create some buys, right? Creating new swing lows, new swing high. Market can pull into discount region again for a buy continuation to take out these highs. Yeah, so this is one example. I think there was another example that happened on Solana. There's one on Solana and one on Doge, right? Now if you look at Solana at this region, Solana was actually creating this bearish move, right? We had this beautiful sell on this region. You can see how market has been selling right all the way here. Then market came, sell, created a even good supply, sell supply zone, right? Now when market was creating that sell supply zone, you see there's a supply zone here that when market push all from this region, it tapped into the supply zone and moved down. But what happened when market came into this POI? So if this POI is a point of interest and you do not want to buy, it means maybe you're not sure if market will actually buy from this point of interest because of how the market has been selling. What you want to do is to wait for structural change. Where's the market selling down from? This was the last low that was pushing market down. Now, if I don't want to take trade aggressively, which I'm teaching you guys not to take trade aggressively if you are new and you don't know all these things very well, because the market on this region is bearish, you want to be catching, right? You want to be catching sell setup. Now, someone who sold from here would want to take profit at this liquidity level below, but now market has tapped into a POI. Then all of a sudden, the market started moving up. Where did the shift happen? This previous low that pushed market down created a structural shift here. Now at this region, right? Once I see this shift, I have a confirmation. It means I can go ahead. This might just be like, oh, I'm scared. I don't know if market wants to actually shift bullish, because definitely market is reacting off a sell supply zone, right? It can also move like this aggressively, create a new low so that market will shift like this. It can also create a new low for the sales to continue, right? Because you had a low, you had a high, you had a low. Market went back to the supply zone. This possibility market should create what? A break of structure to the downside, right? But now you are seeing a point of interest for buy. Liquidity is close to it. This previous low that moved structure is close to it. Market tapped into it. So what you want to wait for is a confirmation, right? And that confirmation is structural. Now, this is the point of interest. Market tapped into it and went and take out the previous high. That is a good structural confirmation here, right? Then what happened? Market tapped into it, created that shift, and now there is an imbalance here. If you do this trade, if you enter this trade, you see that at the 50% level of this imbalance, that's where your buy setup would be. It means market has shifted structure. You can enter for a continuation here. Stop loss will just be below, right? And you target higher regions of liquidity. Then you can see how price 1:4 trade, price just went, it's even 1:5. Price just went aggressively above and took out the structure, right? Very, very clean. Okay, so this is another example. There's also another one that happened. So it's good to observe structural shifts, right? A smart trader would know that, oh, this was high, low. Market tapped into this move, tapped into a bullish POI and shifted structure to the upside, right? Created an imbalance for you to buy, to continue the trade to the upside. So this was where this particular structural shift happened, right? And it's not actually easy to spot. I'm not saying it's going to be very easy for you guys to spot. It will take some time, it will take some practice before you're able to spot it. But if you can spot it, it's going to be a game changer. It's going to really change your game of trading. It's going to help you. Okay, smaller time frame structural shifts, higher time frame structural shifts, it's definitely going to help you. And I think there is also one on that happened on Doge. Same thing, right? If you look at the structure of Doge, it has been ranging for a while, right? But creating good sell zones, right? Creating good sell zones, right? Then you see market moving into a particular sell POI that was here, a particular sell POI that was here, right? So you can see how when market even tapped into this POI, there was a rejection. There was a rejection, right? A good rejection, because when market took out liquidity from here, took out this liquidity, right? Sold from this sell POI. So let's look at it that we caught a sell trade, right? From this sell POI, then market is moving bearish to the downside. We'll be expecting this low to be taken out, right? We're expecting this previous low that gave birth to this high to be taken out. If the structure were to continue bearish, then all of a sudden the market stopped moving from this region and pulled back up. Then we saw a range, an aggressive sell here to the downside. we'll be expecting market to take out this low, right? Then market pulled back up, came back down, did not take out this low, right? The next opportunity you have to take out this liquidity resting low here is this POI. When market was retracing to this, you would expect in market to tap into this region and sell, right? But what happened? Market did not sell from this POI. It went up. So say you took a sell trade off this region and you're stopped out. Market went all the way and took out this previous low. This is the one I would be interested in, right? Say you stopped out at this POI. Market did not sell. The structure was bearish all the way from here, right? But look at where the structural shift happened. You took a sell off a valid POI, then all of a sudden, what happened? Right? Because market took out liquidity, external, going back to internal, market was supposed to create a sell, but decided to shift structure. So this would have been a stop loss for you. Then immediately after the stop loss, what happened? You saw market shifting structure here. This shows you that this POI, though there was you can see how market even ranged here. So there was lots of decision making, right? The market makers decided to change the structure bullishly and a shift happened. Then what happened? Once you saw this shift, POI was created right here. You can see that continuation, right? At the 50% level of this imbalance, you would have caught a beautiful trade around this region, right? Targeting higher regions once you have sensed that shift. Stop loss just below. Target higher regions, say 1:4, 1:5 liquidity. Any areas where liquidity is resting, then you see all of a sudden market just boom went. So what's the observation here? A structure shift from the bearish move to bullish. Immediately you identify that shift, you can go ahead and easily cash a continuation trade to the upside, right? So these are some of the advantages we have identifying the shift in structure, right? You might not be able to see it all the time, and it's not compulsory you see that shift all the time, right? You cannot catch every move. That is one thing about the market. You cannot catch every move, but it's good that you know about it, so that and you practice it, right? You backtest, so that anytime you see the move, it will now create that opportunity for you to know that, oh damn, this guy was bearish from this region. Now market just shifted structure here. It means I can catch a continuation to the upside. Then boom, you can see how market reversed and catch that continuation. So even if you do not catch this move, you go to your analysis time frame and you can wait for a pullback. Maybe when market wants to pull into discount levels for a buy, you can wait for that and you would see it. But that would create you would need to be sure of the kind of reaction market is creating. If it's a bearish reversal, a strong bearish reversal reactions, or a bullish continuation reactions, you would need to take note of that. Also very important. So there's lots to look out for. Because trading the market, we are competing against smart people. So it means whatever moves we want to take in the market, we need to be very, very smart about it and be also patient, right? To understand the structures and follow them. Just like this move, we saw an opportunity here, but we waited for confirmation. Immediately the market shift, we entered into the continuation trade right here at this point of interest to continue, right? Those who entered here would still be in profit, but like I said, the market can take out this structure and you would lose that trade. Then you see a continuation to the downside. But if you have waited for confirmation, because you know that, oh, as market is pulling into this POI, the next structure it wants to shift, it will need to take is this. If market takes this, I would enter. I can enter as the breaker block. I can enter as mitigation block. I can enter as 50% imbalance. Use different entry method now that you now know based on SMC to now enter your trade for a continuation. It will now be easy. And you know that once market has shifted, even though you map out trend line on the bearish on the left hand side, you see that the trend line has also been broken, which is a confirmation that, oh, you can go higher, so, or lower. So it happens based on whatever trend is, either in a downtrend or in an uptrend, right? So this is a wrap for day 60. Thank you so much for watching. See you guys on the next one.